Wescott Economic and Market Update as of December 4th, 2020. I'm Mark McCarron, Wescott's Chief Investment Officer, and today we're going to take a look a little bit in the future, 2021, and we're calling this the road to recovery. So as always, our agenda today is a market update. We'll take you through today, December 4th. We also wanted to focus a little bit more today on the virus update, what's happening currently, and what might be happening obviously in 2021, the reopening of the economy and the market implications of that. And then finally, we'll provide an update on our current outlook, what we expect going forward, and as we look toward 2021, what we anticipate for both the economy and the markets. So first, our market update. And today, we've got some good news and some bad news. The bad news first, the virus cases continue to rise. We're reading today in the newspapers reaching new daily highs in the US, but also globally. So the virus is clearly in a second wave, as expected. And the impact really is that the rising cases will further delay any reopening and may in fact slow the recovery because targeted lockdowns may be necessary. And we're seeing that in Europe. We're also seeing that in some parts of the United States. What does that mean to the economy is that we just got an update today on the US unemployment rate. It's now down to 6.7%, which is great news. It's declining. In fact, approximately half of the 22 million jobs that were lost in 2020 during the pandemic have been regained, which is really good news. Although many in the job market, many in the workforce, may not in fact return. And that's going to be the more of the long-term impact of the pandemic and of 2020. And despite all of that, the daily cases rising and the slowing recovery, the stock markets continue to rise. And I think, our investment committee meets and talks through this on a regular basis, but hopes for an additional fiscal stimulus coming out of Washington, even potentially before the end of this year, despite the fact that there's going to be a change in administration in January. That fiscal stimulus is critical. And I think most importantly, the news on the vaccine front continues to be positive. The fact that effective vaccine may be soon widely available is a huge boost to the market. So one of the things we want to talk about is what is the impact of the vaccine? We're calling this vaccine hopes, but there is a lot of hope out there despite the negative headlines that we're seeing about virus cases. So what are we seeing? So as anticipated, with the positive news on the vaccine front, it's really the economically sensitive sector, the value stocks, and in fact, the Wescott value managers that are beginning to recover some lost ground on hopes that the vaccine will allow a return to normal life in 2021. So as we typically do, we'll show you some selected index performance. The S&P 500 up strongly so far this quarter, up 9.4%. But actually the equal weight index, which is a broader measure, incorporates the impact of all 500 stocks in that index equally, that's up 15%, nearly 16%. And that's a sign that it's not just focused on the top 10 names, not the technology concentration that we've seen, but broader. And actually, if you look over here to the right-hand side of this chart, large growth, which has been the dominant factor for most of this year, is up a very respectable 7.4%. But that's actually the worst performing component of the market. And it's small growth, large value, and small value stocks, in particular, financials, industrials, and selected energy stocks are the ones that are adding the most value since the fourth quarter began. And that's largely due to the fact that the vaccine announcement has come out and there's anticipation of return to normal. So some of the managers in client portfolios that are performing well include Dodge and Cox stock and DFA large cap value. And the fact that they're performing as well as they are in the short term, albeit a couple of months, does show how quickly market leadership can change. So the financials and the industrials, selected energy stocks, we're talking about on the financial side, companies like Charles Schwab, Capital One, JP Morgan, which are all good sized positions in client portfolios. They're all up significantly as expectations of a normalization permeate through the market. On the energy side, Occidental, Baker Hughes, and even on the technology side, areas like Micron Technology, which are outside the consumer tech, but in the more industrial side, all of this suggests that things are improving. I think it's important though, but we look at the quarter to date, which is very strong, but still there's a long way to go. What this graph shows is the year-to-date performance of those same indexes. So the S&P 500, despite the fact that it's up a little bit in the fourth quarter, it's already up 15.5% year-to-date, and this is through December 3rd. The equal weighted index, as we talked about before, which is a broader measure, despite the fact that it too is improving and performing very well in the fourth quarter, still is behind the S&P, which is dominated by that large growth and small growth sector of the market. You can see 33% return for that sector of the market, 23% for the growth on the small side. And if you happen to fall into the value side of the market, again, those industrials, financials, and energy stocks, there's not much return associated with that. So I think there's, on a year-to-date basis, what's important though, as we're beginning to see and look toward 2021, is this shift. The shift in the market, the leadership, and the performance of those sectors. We're happy to see as a broadening, it's a healthier part of the market, and it's a positive to Wescott portfolios. So with that, why don't we take a look quickly at our current outlook. First, the continued monetary policy, which is really set by the Federal Reserve, and fiscal policy, which includes the coronavirus relief bill that's still being negotiated in Congress. These continue to be very critical as support for continued recovery. The second point we make is, while we expect that the most economically sensitive sectors will recover, as we're already seeing, the pandemic has brought forward, I think, many consumer behavior trends that will be with us for the long term. Online shopping, remote work, that type of thing will likely be here long before we're going back to work, back to school, and back to normal. What's interesting on the right-hand side, though, is that if you see the GDP growth rate in the United States, it was trending along a 2.3, 3.8, 2.4% rate, and then the pandemic hit. The pandemic was a very large external shock to the economy. That caused a 31% decline quarter over quarter. But what we actually did see in the second quarter of 2020 is a 33% improvement from that low base. So what's really interesting to see is how quickly GDP has recovered. We have a long way to go before we're back to where we started the year. However, a rebound in economic growth, both here and abroad, combined with the fact that a lot of the market is very attractively valued, particularly sectors of the economy that have yet to participate, we think that will drive the rebound in 2021, and that rebound will be driven by cyclical sectors. So as we talked about before, we're moving, we think, from a pandemic trade, those stocks that do well in uncertainty and a flight to quality, to a reopening trade, where the vaccine hopes and return to normal will broaden out the market. And as we talked about last time, although another wave of the virus cases has begun in the US and around the world, there is a continued slow but uneven economic recovery. The potential we see for a safe and effective vaccine already has started to shift in market leadership, because the prospects for many industries like travel and hotels and others, they improve almost immediately. And as a reminder, our portfolio strategy, as always, continues to emphasize effective and opportunistic diversification, which is really supported by valuations and sound fundamentals. So with that, we wanted to thank you again for your trust and confidence. Please don't hesitate to reach out to me or your advisor if you have any questions. Thank you.